Assalamualaikum and hi. So, here we will be presenting a current issue related to the field of actuarial science, focusing on finance and investments with a special look at cryptocurrency. First, let me introduce ourselves.
Hi, my name is Aina Zahira.
Hi everyone, my name is Nandika Nagaraju.
Hi everyone, my name is Nurul Anis.
Hi, my name is Nur Alis Musfira.
Hi, my name is Nur Ashikin.
Let me start by briefly introducing what cryptocurrency is. Cryptocurrency is a type of digital or virtual currency that is secured by cryptography. What makes it different from traditional money is that it operates without control from any government or bank. Some of the main benefit is peer-to-peer transactions, meaning users can send money directly without needing a middleman, as seen with cryptocurrency like Bitcoin, Ethereum, Ripple, and Litecoin. It's also known for its efficiency, offering lower transaction costs and faster processing time. Because of this, cryptocurrency has become a strong alternative for investors looking to diversify their portfolio. From an actual perspective, cryptocurrency presents both opportunities and challenges. The price volatility and lack of regulation create a challenge risk profile. However, this space also opens up new possibilities for innovative investment products and advanced risk management strategies that actuaries can explore.
In this discussion section, I will highlight key developments in cryptocurrency and how they impact the financial market and investor behavior. Firstly, one of the most important features of cryptocurrency is its decentralized nature. Unlike traditional financial systems that rely on central banks, cryptocurrencies like Bitcoin and Ethereum allow direct peer-to-peer transactions through blockchain technology. This innovation changed how we think about money and transactions, and it opens up access to decentralized financial services such as DeFi. However, volatility is a big issue. For example, Bitcoin's price jumped from around 1,000 to nearly 20,000 in 2017, then dropped sharply in 2018. This makes cryptocurrency both risky and attractive, especially for investors seeking high returns. Many now include it in diversified portfolios, and even institutional investors are entering the space, giving crypto more legitimacy in financial markets. Another major concern is the lack of a consistent regulatory framework. Countries are handling this differently. For instance, China bans it, while El Salvador embraces it as legal currency. Without clear rules, cryptocurrencies can be used for money laundering and other illegal activities, especially due to the anonymous nature of the transactions. Lastly, the growth of cryptocurrencies raises systemic risks. As
Factors of
DeFi, or well known
development in the
as
issue. The
decentralized
first cause is
finance
that
platforms,
cryptocurrency is
become more
decentralized.
popular and
This means
crypto
it's not
gets
controlled
more
by any
integrated
central bank
into
or
global
government.
finance.
Instead, it runs
Any
on blockchain
major
technology
market
where people
crash
can
could cause
send money
ripple
directly to
effects.
each other.
This is
The
a
problem
key
is,
concern
with
for
no central
financial
authority, it
professionals,
becomes very
including
hard to regulate
actuaries,
or
who
prevent
must
legal risk.
assess the
Secondly,
long-term
crypto prices are
impact on
extremely
financial
volatile. For
stability.
example, Bitcoin once
In
went from
summary,
1,000 to
while
20,000
cryptocurrency
in
brings
just 1 year and
exciting
then dropped fast.
opportunities for
This kind
innovation
of
and
instability
investment,
makes it
it
a
also
very risk for
demands
investors
serious
and
attention
difficult
to
for actuary to
regulation,
manage
risk,
financial
and
risk
the
properly.
overall impact
Another
on the
cause is
global
that there is
financial
no
system.
consistent global regulations. Every country treats crypto differently. El Salvador, for example, legalized it while China completely banned it. Because of this, there is a lot of confusion and opportunity for people to take advantage of weaker law. Next, we have the environmental impact. Mining cryptocurrency takes a lot of electricity, especially with systems like Bitcoin. In countries that use coal or fossil fuels, this creates serious pollution and harms the environment. Then, there is the fact that many people don't fully understand how crypto works. Since the system is digital and use complex technology, beginners can easily fall for scams or make bad decisions without realizing it. Lastly, cybersecurity is a big concern. Cryptocurrencies are often targeted by hackers, and because crypto transactions are final, once your money is stolen, you usually don't get it back. All these causes has led to the serious impact on companies, countries, and society. For businesses, especially fintech company, crypto can be risky. When prices crash, companies lose money and may need to change their business plans. That's why many firms are not using better tools to manage financial risks. In terms of national policy, countries has reacted in different ways. China banned crypto to protect the economy and control capital flow, but El Salvador decided to make Bitcoin legal to help people without access to bank. Unfortunately, many of the citizens were unsure about it due to the price swings and lack of trust. For local community, mining activity has caused environmental damage and increased electricity usage. In some areas, this even led to higher electricity bills or power shortage, especially where mining farms are located. There is also a rise in scam and fraud. Many users don't know how to protect their digital wallets, and once someone falls for a scam, they usually cannot recover their money. Cases of phishing and fake coins are becoming more common. Lastly, as crypto get more involved in a mainstream finance, there's growing risk to a global economy. Big companies and banks are now investing in crypto. So this is something that actuaries now need to include when they assess long-term financial risk.
Alright, next, let's talk about how individuals, companies, and countries are approaching cryptocurrency and how that's shaping our financial system. First, let's start with individuals. Many people see cryptocurrency as an investment opportunity. They buy, hold, or trade popular coins like Bitcoin, hoping for high return or portfolio diversification. But the crypto market is very volatile. Price can rise or drop quickly. Because of this, smart investors often limit how much they invest and use risk management strategies to protect their money. Now, how do individuals keep their crypto safe? Since there are risks of hacking and fraud, more people are using tools like hardware wallet which store crypto offline. They also use two-factor authentication and core wallets to add extra layers of security. This is important because online wallets and exchanges are often targeted for cyber attacks. So overall, investors are getting more serious about protecting their digital asset. Next, let's look at companies. Big names like Tesla and PayPal has started using cryptocurrency. Tesla allowed car purchase with Bitcoin for a short time, while PayPal let users buy, sell, and hold crypto in their account. This shows companies are listening to public interest in digital currency. Beyond that, many fintech companies are building crypto-based products like crypto ETF and cryptocurrency insurance. These tools help connect traditional finance with the new digital world, giving investors more options. Okay, the next point, but just like individuals, companies must manage risk also. They need strong compliance system to meet evolving laws and protect themselves from issues like fraud or money laundering. Finally, let's look at what countries are doing. Some, like El Salvador, have fully embraced crypto. In 2021, El Salvador became the first country to make Bitcoin legal tender, aiming to boost financial inclusion, especially in rural areas. Others, like China, are more strict. China has banned crypto trading and mining due to concern about financial stability, energy use, and illegal activity. They even block access to crypto platforms, preferring to keep full control over their economy. Meanwhile, countries like United States, Japan, and European Union are developing clear rules and regulation to support innovation while protecting users. There are also environmental concerns. And lastly, many countries are developing central bank digital currency. In conclusion, from individual to global powers, everyone is reacting differently to the rise of cryptocurrency. Some embrace it, some regulate it, and some are building alternatives. These choices are shaping the future of money and creating a new challenge for financial experts and actuaries alike.
Next, I will talk about what we have learned from an actual perspective when it comes to cryptocurrency. One of the main lessons is the importance of strong risk management due to the high price volatility in cryptocurrencies like Bitcoin and Ethereum. Although crypto is unpredictable, traditional actuarial tools like VAR can still be used. Studies show that when VAR is combined with models like Tigars, it can still give accurate forecast even for crypto. Another challenge is regulatory risk. Because different countries have different laws on crypto. The market is uncertain. For example, China has banned mining and trading. Actuaries need to consider this policy risk when assessing investments or creating financial plans. Cryptocurrency is still new, so there is a limited historical data. Traditional methods that rely on past trends may not work well, but we have seen that using tools like machine learning and even Twitter sentiment analysis can help improve prediction. This modern approach allows actuaries to better price crypto-based products. Cryptocurrency mining, especially Bitcoin, uses a lot of electricity. This leads to environmental concerns like high carbon emissions. Actuaries need to consider this risk, especially as the world moves towards greener investments and climate-related regulations. Crypto is also a target for cybercrime like hacking, fraud, and theft. Actuarial models are now evolving to include cybersecurity risks. Actuaries may also work closely with cybersecurity experts to check how secure exchange and digital wallets are. Lastly, crypto's growth could affect the broader financial system. Big drops in crypto value or the collapse of major exchange could spill over into the traditional markets. Actuaries should include this risk in systematic risk assessment to prepare for possible wider impacts.
Based on our review, we propose to 6 key recommendations to optimize the benefits of cryptocurrency while minimizing its risk. So, firstly, we need to have a global regulation. Different countries currently have inconsistent rules that leads to confusion and fraud. An unified regulatory framework will ensure anti-money laundering measures, investor protection, and also clear tax rules. Countries like Japan have shown the balanced regulations that can support innovation and safety. Secondly, we must tackle the price volatility. Crypto's extreme price swings make it risky. We recommend using stablecoins backed by real world assets, developing crypto insurance products, and using advanced tools like Monte Carlo simulations to predict and manage risk more efficiently. Thirdly, there is a issue of environment impact, and coins like Bitcoin uses large amounts of energy. So switching to a greener consensus system like proof of stake, as Ethereum has done, and encouraging renewable energy use in mining, as seen in Iceland, are also important steps to eco-friendly crypto. Next is on security. With cyber threats increasing, exchanges and wallets must enforce two-factor authentication, keep funds in or offline storage, and undergo regular security audits. Specialized insurance is also crucial to cover losses from hacks and theft. Fifth, we have to highlight the lack of public education. Many users still don't understand how crypto works. We propose accessible education programs, targeted training for financial experts, and expert guidance for lawmakers developing crypto policies. Finally, collaboration is essential. Governments, banks, tech firms, regulators must work together to develop secure and trusted digital currencies like central bank digital currencies or CBDCs. This joint effort will help bridge the gap between blockchain and traditional finance. Thank you. Cryptocurrency has a huge potential and needs certain rules to manage risk. And we should implement certain recommendations like stable market, clear rules, green solutions, strong security, and global cooperation. And teamwork is also essential. For example, governments, business, and experts should work together. And with the right balance, crypto can make finance faster, more fair, and safer for everyone. Thank you.